Well, welcome to Beers with Rich. I'm Rich, editor of Under the Radar Report. Well, it's great to be back. So first up, Happy New Year. Wow, I couldn't go past this little number. Let's just take it out. Panhead, New Zealand's finest. Yep, it's called another IPA. Funny that, Tumbling Dice. Shut off gas. I don't know what that means. Anyway, there's some poetry on the back. Let's just leave that as well. Let's just crack it open for 2022. Here we are. A big crack. A big crack deserves a big cold beer, and a big cold beer deserves Panhead's Tumbling Dice. Well, fuerte, as the Spanish would say. Strong. Anyway, I'm told by... Boy, it is strong. It's strong. I'm told by one of the team that Panhead is one of a number of boutique brewers that has been taken over by a global behemoth, Lion Group. When I actually first covered brewers when I was a stock market analyst way back when, and Lion Nathan was one of my stocks. But that was taken over by Kirin. And like this kind of consolidation of the brewing sector is what's going to happen in Fintech, and that's what we're going to talk about later on, because this sector has been hit very hard and we're seeing opportunities. But first, and let's just have another sip. Well, flirty. There's been quite a bit of selling this year, if you haven't noticed, even though the year has hardly begun. The All Odds has declined along with the global markets around 10%, and there's been a bit of rebounding this week, so it's now about 7% lower than its level at the end of last year. What's going on? Well, subscribers will know because we've been talking about it a lot in recent publications. And the key, as always it seems, is interest rates. So the market's getting itself in a twist over central banker comments and actions that indicate that monetary policy is tightening. This hasn't happened for quite some time, and people like Jay Powell, the Fed Reserve's heavyweight, are indicating interest rates are going to go up faster than the market had previously expected. Like they're factoring in over 3 interest rate rises this year, official interest rates, plus a tightening of the QE spend on bonds. So there's a lot happening, and I guess this is all due to inflation concerns, albeit they're pretty volatile in the US, which we've talked about. But I guess a lot of it is missing the bigger picture, and that's what we talk about in Blue Chip. And the central bankers, as important as they are, and as influential as they are paling, and they really do pale in comparison to the bigger force driving, interest rates down. And I'm talking about a global savings glut. And so that's basically what Bernanke first talked about in 2005, which is where global savings from, countries producing a lot of savings and not much consumption, basically spending their money on US treasuries, on houses, and now increasingly on risky assets like cryptocurrency and the latest fads. So that's what happens when interest rates are pushed down. And even though there's a lot of hype about interest rates, the big money in the bonds are saying that interest rates aren't going to go anywhere, in terms of 4% plus. So at the moment, US Treasury yields are 10 years are under 2%, as are the Australian sort of 10-year bonds. So, and in Europe, they're actually in the negative. But what's happening is, because interest rates are coming off such low rates, stocks that aren't making any money are called long-term assets. They're going to have to work a lot harder to justify their prices. So these stocks are very vulnerable. But what we've also seen is that companies across the board have been hit. So that gives us a lot of opportunities to buy, a lot of opportunities to top up on quality companies, because that's what we're about. We make money from companies over the long term, so we're always looking at paying good prices for quality companies. That's pretty much the game that we're in. And okay, we're getting excited. One area we've had our eye on for a long time, or we've been sellers of last year, is fintech. And there's been carnage. We were sellers of fintech because we saw the risk on the horizon, the regulatory risk, and also the credit risk. And the hype, the valuations were just going crazy. Look at what happened in PayPal this week. I mean, the stock got hit 25%. I mean, this is a big company, one of the biggest payments giants in the world, one of the biggest companies in the world, because it's not growing as fast as expected. So, what's happening in PayPal mirrors what's happening in the broader sector. So they were chasing volume during the pandemic. They were getting lots of accounts, but these accounts weren't profitable because they weren't actually trading. So basically, they're now looking at profitability, and that's the market. The market's looking at profitability. So a lot of these companies have really been hit hard. Zipco's at 20% of levels it was 12 months ago. Afterpay and its purchaser, Square, now called Block, they're 50% lower. And one company that got hit is Beforepay. And Beforepay was marketed as a buy now, pay later company, but it's more, when we looked at it, more a lender. More a lender, a payday lender. So they have this technology that involves algorithms that uses a credit check for individuals, against their expected pay. So, but how well this technology works with such changing economic conditions is questionable. They had Brian Hartz from Westpac as chairman of the board, or they have him. So that gives some credibility, but whether that credibility translates, to how well this technology performs is questionable. And also, debt recovery in the best of times is difficult, let alone, when interest rates are starting to rise. But what we're talking about is looking for companies that can survive, but as well as little companies where, okay, your valuation is much lower and you're getting potentially more bang for your buck. One of the former companies that we're seeing is Zipco. So this company's, as I said, 20% of levels it was 12 months ago, but it's still at like a $2 billion price tag, by its market cap. These guys, we've covered them for a long time. They offer a digital wallet where customers have approval to purchase up to $1,000, at merchants or retailers, but it's been sold heavily, considering what we're seeing is growth in its quarterly numbers. And that growth is because it's really, here's to Zipco, they've done pretty well to survive, but, there could be a buying opportunity, but they've basically had a big acquisition, program. But, at the big end of town, there's still a lot of risk. At the smaller end of town is where you might get more bang for your buck on a risk-adjusted basis. Like Zipco, $2 billion, Splitit, Israeli-based Splitit, under 100 million. So that's a tenth of the size. So it's an outsider with potential. So the company's technology levers off existing credit card holders, like Afterpay, like Zipco, but they're aimed at maybe top end of unit transactions like $1,000. Splitit also has partnerships with big operators, including Visa and Goldman Sachs. So there's risk with Splitit, but you're not paying too much for this risk. And of course, there's that global potential. I think they report in US dollars, so they're more in the US than in Australia. The point is, people, let's just have another sip before we get to the point. When there's carnage, there's opportunities. Fintech, once the belle of the ball, who could say anything bad about fintech? Now it's on the nose. Now it's interesting. Now we're not jumping all over the sector. We're saying, okay, there's some interesting stocks to nibble away at. But at times like this, when when that kind of momentum is absent, you need to work harder on the analytical side, which is where we come in. What's coming up? Well, we're digging deep. Speaking of digging deep, we're going into uranium and lithium reports coming up. But more than this, we're going to be delving deep into the financials of over 150 companies. because that's the number of companies we cover, of the 2,500 or so that are listed on the ASX and are going to be reporting this month. So companies lift their hoods and take out their crystal balls, and we're there to keep them honest. And it's always paying attention. It's always worth paying attention to what they say, because what they say now compared to what they've said in the past is what counts. And also outlook statements will never be more critical. So, here's to talking the talk. Here's to walking the talk. Happy New Year. Great to see you back.